Hello everybody. Today we have Duncan Davidson with us. Actually, we're very thankful to have you here. He's Managing Director at the Silicon Valley-based VC Bullpen Capital. He's also a serial entrepreneur, so he knows both sides actually. And we're very happy to have you here, and we're very much looking forward to the talk, and very much looking forward also to get insights in how experienced investors actually invest in the Silicon Valley. So great to have you here.
Great. Thank you. I enjoy being on this call. This is a presentation I put together to explain how venture had changed over the last 5 or 6 years. The venture industry in the United States has gone through a very serious disruption, probably the biggest disruption in its history, at least in the last 30 years. And we are, the fund I'm with, which is Bullpen Capital, is in the middle of that. What I'd like to do is explain to you what has changed and then discuss how that might affect your raising of money. So first of all, it's been a real revolution in venture. I use this socialist realist look. My daughter drew it just to be edgy. What happened in 2008 at the bottom of the financial crisis is the leading U.S. venture fund, Sequoia, put out a report. This says, "Rest in peace, good times." They were basically saying that the venture situation was over with. What happened almost immediately without them were a whole series of companies, and I'm sure you're familiar with most of these. And the reason why is this slide, and this is probably what's driving the Austrian battle camp as well. In 1999-2000, the last time I did startups, I did 2 startups in the late 90s. It would take at least $5 million to start a company. One of my companies, Covad, was building out infrastructure. The first round of outside money was $10 million. And that company went on to raise $2.2 billion. But if you go forward to 2005, when there was a series of fundings in something called Web 2.0, open source software had reduced that $5 million down to $500,000. It just took $500,000 to start a company. When you go to 2010, when this venture revolution really took off, it took only $50,000 to start a company. A couple kids in a dorm room could start a company, rent the cloud from Amazon, sit on top of open source. I would assume most of you are aware of this change, but this change had a completely profound effect on funding. Now what's going on are people are beginning to build the web at the top level, that orange level, the web-based or mobile-based products and services. Everything below it, chips, operating system, networks, the web infrastructure, cloud infrastructure, has become a commodity. The venture industry is still investing in those light green commodity layers, but frankly, it's over with. All the activity and all the value is going to the orange layer at the top. You see a much younger group of founders than we saw in 1999. You might recognize a lot of these people. And a much younger group of venture people who are more technically operating oriented. This has led to a flood of new funds. Some of them are called accelerators or incubators. Some of them are called super angels. Most are just seed funds. Again, I assume you can recognize many of the names on this chart. Bullpen Capital is a fund formed in 2011. We follow the seed funds. We have counted 92 different funds sending us deals. And we think there are over 130 institutional seed funds in the United States and over 200 worldwide incubators and accelerators. In contrast, the traditional venture industry is down to maybe 85 to 100 active fund managers from a peak of 1,000 in the year 2000. A complete change of the business. Now this new breed of fund, this chart is a little bit old, but it's certainly continued. This new breed of seed fund is winning the front end of the venture funding cycle. What you can see here in the red part are the traditional venture funds doing a Series A. And the blue part at the bottom is the seed funds doing the initial funding. The bottom was reached in Q2 of 2009, and then this disruption took off. When I first did this chart in Q311, I thought it would be 50-50. It's now very clear in 2013 that almost 80 or 85% of all internet U.S. venture deals are first funded by the blue seed funds. And the traditional Series A funding, as it used to exist, is going away. The lean model this is based upon changes the curve. In the traditional venture curve, you raise $5 million in your A round, $12 million in your B round, $25 in your C round. That's the red curve. In the new lean curve, you're raising $1 million in your seed round, which is the new A round. You're raising about 2 to 3 in the next round, which is the new B round. Whatever the letters are, that's what it really is. And then you begin to catch up as you scale the company. The terms of this new set of funding are much different than the old. The funding type I'll call lean. You want to raise $500,000 or $1 million. You don't want to raise $5 million. Whereas the traditional funds tend to have what I'll call fat funding. They want to write a check of $5 or $6 million. The very first investment Bullpen made was a company called a Sisley. We bid $2 million round, and we beat a traditional venture fund bidding $6 million at twice the valuation. And it's extremely interesting to understand the dynamic of why the founders and the early venture people took the $2 million round over the $6 million round. But that's what's going on now. The type of investment in the new way is convertible debt, whereas in the traditional way it was preferred stock. The goal of the new way, and why a Sisley took our $2 million round, is to keep options open. In the case of a Sisley, the founders had twice sold companies in the 1990s, had big valuations. But they raised the $5 million, $12 million, $25 million venture approach, and they eventually had $90 or $100 million of venture money in their companies. And when they sold the company, they owned a very small percent, and they didn't make any life-changing money. In the case when they took our $2 million, about 9 months later, it was bought by Salesforce.com. Very quick return on money. But for the founders, they suddenly made life-changing money. Having twice sold companies and not made life-changing money, it's really exciting when you can sell a company quickly and make serious money. And they're still working at Salesforce.com and very happy with it. So as you can see, in the new breed, it's also about quicker return of money, and the founders keep control. The other thing that has changed in the U.S. venture markets is the IPO business. It may sound really sort of quaint, but look at these earlier tech cycles, Cisco, Amazon, Microsoft. Amazon goes public in the 1990s and only gets valued at $440 million. That's at 0.44. You could contrast that with Facebook going public and being valued at $70 billion, or you can look at Twitter being valued in the $15, $16 billion. Now, Amazon from $440 million has now grown to well over $100 billion of value. So if you invested in the 1990s, held onto the stock, you could have made 200 times your money. A normal person putting $10,000 in that Amazon stock would now be a millionaire, a multimillionaire, in fact. If you go buy the Twitter stock at whatever it went out at, you buy Facebook, it's not going to go up 200 times. So the second thing that changed is the IPOs changed. Instead of taking companies out in the modest valuation and having most of the appreciation go to the public investor, now they're held off the market for a long time, and most of the appreciation goes to the venture people. Now, this has created a marketplace for secondary selling or quick flips, and in fact, incentivizing people to get out quickly instead of holding it to the IPO. Now, I've given you a high-level flavor. I'm going to want to go down into more detail. I just want to leave you one more thing to think about. The tech booms are what I call endogenous, meaning they come from within the industry. There was a tech boom around the PC in 1980. There was obviously the dot-com bubble in the 1990s. And now we're in the third tech boom. These things happen almost regardless of external market conditions. And they're accentuated if there's a stock bubble. But in the 1980s, there wasn't a stock bubble. It's actually fairly bad economic times. And it's hard to say that the current economic trauma we're in is anything like it used to be. But what I think is going on is the following. Right now, if you're a money manager and you look anywhere in the world for where you put your money, there's no good place to put it. I mean, people are not wanting to invest in Greece. They're actually not wanting to invest in Europe. They think that China is ending as an investment play. A lot of the emerging markets, Russia, Brazil, India, do not look that attractive anymore. The one place in the world investors look where you can get outsized returns on your investment is in tech. And tech has gone through a very, very big bubble in the last few years. Right now in the U.S., IPOs are back in a way they haven't been since 1998. Now let me draw implications for you, then I'd like to open this up to questions. What all this means to entrepreneurs is, number one, you don't need a lot of capital to start a company. And number two, you don't really need a track record. What you need to do with a great idea is build it in the modern way. And the reason you don't need a track record is if you can launch your company or your mobile app into the market and get feedback from the market of how well or poorly you're doing, you can raise money. It doesn't matter who you are. It doesn't matter where you come from. Most of the technology deals are being done in Silicon Valley around the world, and there's this great sucking sound to bring people into Silicon Valley. But startup culture is spreading all over the place. My fund has a really good deal out of Edinburgh, Scotland. It's doing spectacularly well. We have looked at things in Europe. We've looked at things in Mexico, Latin America. We've looked over in Singapore, Japan, Australia. So we look around the world for ideas. And we're not really that concerned with the founding team, provided they show they can build technology in a modern way and their product or service has some indication of how well they're doing in the marketplace. Now, I could keep going. I want to pause right now and open this up if anybody has any questions so I can dive in a lot deeper.
Yeah, thank you very much.